I've got to warn you small business owners about the two different kinds of business loans that you can get oftentimes in a small business. So there's like your standard loan where you have an interest rate. It's kind of like how a mortgage works. If you borrowed 10 grand, a lot of times the interest is higher in the front because you are borrowing more money. And then over time, it will slightly go down and get smaller. That's fine. That's a general type of loan where if you pay it off early, say you take that $10,000 loan and then you get 10 grand, you can pay it the next month. You just pay interest for the time that you borrow the money. There is a new type of loan that's gotten really popular, kind of started with payment processors like Stripe, but there's also things called Fundbox. I won't name a few of the other lenders that I've seen because, they're smaller. It's not, big corporate type thing. But basically what this type of loan is, and I forget what they call it, but they bake all of the interest into the loan immediately. So it's something like you'll borrow $50,000 and you have to pay it back over 9 months, but they just say the cost of capital is $12,000. So your total payoff amount is $62,000. So they'll divide $62,000 by the 9 months. So you pay 1/9 of 62,000 all 9 months. The catch is that, well, one, it's a massive interest rate and it's terrible. But the real catch is that you could have that money, you could have that 50 grand next month and want to pay it off, but you would still have the extra 12 grand, not just 1 month of interest. You completely bake in your entire interest payment when you take the loan out. Sometimes they call that like the cost of capital or, fees, interest baked in, whatever. So like Stripe loans, when they offer to give you like a $30,000 advance of deposits, that is one of those loans. So they'll say, here, we'll give you 30 grand. You just got to pay us back 36, which doesn't sound that bad. It's like, yeah, that's 20%. But what they're doing is taking 10% of your sales for the next 6 months. You're only borrowing that money for an average of 3 months and you paid 20% to do it. That's like a 80% interest rate. It's not perfect, but it's not like a real bank interest rate. Well, look out for these types of loans because they're absolutely screwing you. People don't understand what they're doing. I've had so many clients who they're like, hey, I got a new line of credit. And I, look at the loan doc details and that's what they did. They just signed up, in a year to pay $15,000 of interest on a $50,000 loan, a $60,000 loan. I've seen them up to 200 too. So it's pretty brutal. Oftentimes when you do it from a third party like that too, you're personally guaranteeing it as well. So be very cautious with these lines of credits and small business loans as they call them.